With interest rates as low as they are right now, wouldn't it be really appealing to have a 7.12% government-backed bond in your portfolio? But is it right for everyone? In this video, I'm going to educate you on what is available to you and whether or not it is something that you should be thinking about in terms of your financial planning. But before we get there, subscribe to my channel, hit the notification bell so you're alerted to when we post new videos. I have over 30 years of experience in this industry. I want to share with you my perspective, what I've heard, my conversations with my clients so that you can do the right things for you, having learned from what others have done and the mistakes that they have made. Now, I want to make this clear from the outset. I am not providing you with investment advice here. I don't know anything about your circumstance, what risk you should be taking, what cash flow you need, what stage in life you're in, what issues you're dealing with. So I want you to take this information to your advisor and have a conversation with them. Again, this is not to be construed as investment advice for your situation. Now, this is a very difficult time to invest. It may sound crazy that I just said that. The Dow over the past 10 years has averaged almost 16% annually, which is way higher than historical norms. I mean, why would it be crazy? But not everyone is invested, nor should they be invested 100% of their portfolio in equities or stocks or in the Dow. What that means is we all have diversified portfolios, which include not only equities, but what we call fixed income or bonds. And for many retirees, it has been the fixed income and the bond side of the equation, which has generated the income that they have needed in retirement, where they've relied upon the interest or the yield coming from those bonds to help them pursue their goals. But what's happened in the last number of years? Interest rates have continued to slide down. Now, what's gone really unnoticed for most retail investors is that we've pretty much completed a 40-year bond bull rally. What do I mean by that? Typically, a bull rally is when, prices and values go up, and we tend to think of bulls and bears in terms of equities and stocks. But it's also true on the fixed income and the bond side. Because the reality is, as interest rates come down, the value of your bonds go up. And we've really had a tremendous long-term run on the bond side. But now things are changing, and interest rates are starting to move back up. And that evidenced itself in the performance in 2021 of the core U.S. aggregate bond index, where it actually lost money. And there are some out there who believe that that could happen again in 2022, something that has not happened in many, many years, where we've had back-to-back negative returns in the core aggregate U.S. bond index. Now, what makes it even worse is that we have an inflationary spiral right now that for many retirees means they need to be generating more income now, not less. So what do we do? Where do we go? So let's start with putting this in context for a moment. So for some of you, you may be aware of there are different sectors and places to invest on the equity side, the stock side. There you could be in growth or value. You could be in high quality or low quality, high risk or low risk, domestic, small cap, large cap, international, emerging markets. You have a similar set of different style boxes on the fixed income side as well. And you need to be taking a look at that now and potentially, again, talking to your advisor, see if you should be more actively managing this side of the equation. So as a general sense, okay, just so you understand, there are 3 different sets of durations for bonds typically. Very, very short duration, mid-term, and then long-term. The short duration you could kind of think of as your 1-year CD, and the longer term, or if you will, 10 years and beyond. And as interest rates move up or down, there is more volatility or price action in the longer term durations than there are in the shorter term. So that's one component, is the duration of your bonds. Then there's the risk level of the bonds, whether it's high quality, medium quality, or low quality. You've got AAA rated bonds, you've got A and B rated bonds, you've got junk bonds. So in putting together a portfolio for your fixed income or bond side, you should be looking at incorporating some of those style boxes that are appropriate for you and where you get guidance from your advisor. So here is where I want to introduce to you the 7.12% government-backed bond. But before I get there, I have a question for you. Are you truly prepared for retirement and generating the income that you need? In my latest book, Don't Outlive Your Money in Retirement, what we did was we created a quiz. You can go up to my banner, you can hit the quiz, take you 2 minutes to fill it out. I'll get you back very quickly a score, whether or not which of the 3 retirement preparedness stages you are in. I'll give you a free chapter of the book along with a couple of worksheets so that you have more clarity in terms of whether or not you are really prepared for this next chapter of life. So the 7.12% government-backed bond, is it right for you? Is it real? Is it a scam? Let's get into it. These bonds are called Series I savings bonds. They can be used for a number of different purposes. Finance education, supplement your retirement income, give as a gift. As of January 1, 2012, paper savings bonds are no longer sold at financial institutions. This action supported the Treasury's goal to increase the number of electronic transactions with citizens and businesses. And the initial interest rate on new Series I savings bonds is 7.12%. And you can buy these bonds at that rate through April of 2022. As you can see, the current rate is 7.12% for bonds issued November 2021 through April of 2022. The minimum purchase, if you purchase it electronically, is $25, and if it's paper, it's $50. The maximum purchase per calendar year is $10,000 electronically, $5,000 if it's paper. And you can buy in different denominations, as indicated here in the paper, $50, $100, $200, $500, or $1,000. Electronically, you can do $25 and above. So you can buy the I bonds at face value. The interest is driven by the fixed rate and a semi-annual inflation rate. And the interest that is earned is added to the bond, and you can collect it when you cash the bond in. So let's go over some of the redemption rules. The minimum term of ownership is 1 year. The interest earning period, it's 30 years or until you cash them, whichever comes first. And the penalty for early redemption, if it's before 5 years, you'll forfeit interest from the previous 3 months. If it's after 5 years, there's no penalty. So let's take a look at some of the tax considerations, which are very interesting. Savings bonds are exempt from taxation by any state or political subdivision of a state, except for estate or inheritance taxes. Interest earnings are subject to federal income tax, and interest earnings may be excluded from federal income tax when used to finance education. One question I do get with regards to Series I bonds is what's the difference between a Series I bond and the double E bonds that many of us may be more accustomed to hearing about? The major difference is in the fixed rate that the double E offers. The I bond is variable, but the double E bonds are fixed, and basically you'll double your money if you hold it for the full 20-year period. So I suggest, now having the knowledge about the 7.12% government-backed Series I savings bonds, that you talk with your advisor to find out whether or not it would be appropriate for your particular objectives with regards to your own financial planning.